Okay, thanks, Jeff, and thanks to the organizers for having me. I'm excited to be presenting this a working paper with you all. So I'm going to jump right in. Why are we here? In the past 50 years, we've seen institutional ownership of the U.S. equity market and mutual fund ownership in particular grow a whole lot. And we've got a conventional narrative as to why this has happened. You know, people have said, look at ERISA. This pushed a ton of retirees into mutual funds. And we've seen some other, rationales put out there. Investors now accept modern portfolio theory in a way they didn't before. Another big piece of this, conventional wisdom says that, well, investor preferences have changed a lot. Now, all of a sudden, we see investors wanting to invest in passively managed mutual funds. And this has led to a dramatic rise in the types of asset managers that specialize in passive funds. And I'm going to refer to these as the big three of Vanguard, BlackRock, and State Street. And as this has happened, scholars, including myself, have looked at this rise of mutual funds and the big three in particular with alarm. And some have even said soon these institutions are going to control corporate elections in America. And so this has generated scholarly conversations across different disciplines. We've seen some concerns about anti-competitive conduct. So what happens when now all of a sudden we have a few really important shareholders across industries? Are they going to push for anti-competitive conduct? We've also seen concerns about governance. What happens now when our largest shareholders have the worst incentives to engage in stewardship and monitoring? And there's also been, the strain of democratic concerns. So what happens when we have really concentrated economic power in just a few institutions and actors? So as this conversation has evolved, we've seen some really dramatic proposals come about. We should break up the big three, some say. We should limit the size of their holdings. And lawmakers following this logic have actually adopted a bill that would require index funds to pass through their votes. And again, the fear is that if we see this growth continue on pace, this is going to be a big deal. This is going to necessitate really drastic action because you're going to see just a few institutions controlling the U.S. equity markets. Okay, so that's why we're here. And what we hope to do is provide a more complete account about how and why these institutions have grown over time, which we hope will also allow us to make better predictions about the future. And so again, this conventional story that institutions grow because an investor goes and puts money into a fund or maybe takes money out of one fund and chooses another. We call these flows reallocational flows. This is part of the story, but it's not the whole thing. And we show a few other things, other factors that actually matter for growth and ownership over time. And this includes fund fees and returns, firm payout policies, investors' reinvestment of fund distributions, and aggregate corporate distributions and equity issuances. Each of these things matter for growth in ownership. And as part of this, we also provide the most complete picture of asset manager size and historic growth to date. And I think this is going to reassure some of you who've been nervous about this phenomenon. If the people who fear that the big three may be taking over the whole world, will be a reassuring picture for you today. So before I get into the math, I'm going to go over sort of a high-level example that shows the intuition behind our framework here and what's novel about it. So in this example, I'm going to use, and it's going to be very simple. We have a market with one company, Company X. We've got two mutual funds. One is Fund A, which is actively managed. We've got Fund P that's passively managed, and each hold about 50% of Company X's public float. Okay. So now imagine we've got investors coming to Fund P and they want to invest. Let's say, okay, they're excited about passive funds. They read in the Wall Street Journal that this is what they should be doing. And so now the fund is going to take those dollars and purchase shares of Company X from Fund A. And so let's also assume there's no changes in Company X's outstanding equity. So of course, over time, Fund P's ownership is going to grow relative to Fund A. They've got new investors putting dollars in. This is, again, this sort of scenario exhibits this conventional wisdom that this is how funds grow. You get investors who prefers one fund over another, and that's going to affect the fund's stake size. So now let's imagine, let's relax that assumption that company X's outstanding shares remain constant. Now imagine that company X is going to do a buyback. They're going to repurchase some of its shares from Fund A. So what's going to happen? Company X's market value is going to decline. Fund P is now going to be holding a larger share of Company X, even though its dollar ownership is the same. Fund A is going to see its ownership of Company X declining. So this is importantly mapping index fund practice to a degree. Index funds don't typically participate in buybacks when they're announced. So this means that a lot of other institutions will be selling into the buybacks like Active Fund A, and they're going to see their ownership shrink in the wake of it. Okay, so another way that this can work is with equity issuances via IPOs and SEOs. This can similarly affect ownership depending on the degree to which the institution participates in that offering. Okay, and a related mechanism for growth and ownership is a fund's portfolio return. So now imagine Fund A's got above market returns. So this could lead to growth and ownership for two reasons. There's a direct effect, right? Which is that, hey, if you have above market returns over time, your ownership will grow. There's also the indirect effect, which is if you have above market returns, flows are going to come your way, right? So less obviously, fees can actually affect ownership too. So now, turning to our example, we've got Fund P, let's imagine, has an expense ratio of 0.1%. Fund A, the actively managed fund, has a fee that's 10 times higher at 1%. So Fund P is going to have more cash to invest in the market, which is going to cause its ownership to grow more quickly. So of course, again, this also sort of tracks what we see in the real world because passive funds tend to charge lower fees than active. So this practice actually provides another mechanism for differential growth and ownership over time. Okay, the last one before I get to the math and then the data, firm payout policy. So this consists of the company's distribution of excess corporate cash and the investor's decision basically to either take the cash out and spend it or to reinvest. So that will also impact ownership, and here's why. So imagine we've got Fund P, and let's imagine that Fund P, like most mutual funds, is going to automatically invest investor dividends in the underlying portfolio company. So dividends can't be reinvested in the aggregate, so Fund P's got to reinvest by purchasing shares from other selling shareholders. And now let's imagine that Fund A, their shareholders are not entitled to automatic dividend reinvestment. So when Fund A's shareholders get a distribution of cash, so a dividend, for example, those investors might take it out, they might spend it, they might choose not to reinvest. Some do, and that will cause Fund A's ownership to decline relative to Fund P. And so here, the direction that this would move in is a little bit uncertain. Typically, actively managed mutual funds and index funds automatically default their investors into automatic reinvestment of dividends. ETFs don't. ETFs make you, go back and maybe even charge you a fee to reinvest your dividends. So all in all, this, automatic reinvestment of dividends is going to entrench certain institutions that specialize in mutual funds, not ETFs, relative to others, and also relative to retail investors. Okay, so that's the super high level framework. Now I'm going to show you what this looks like using math very briefly. It's the end of the day. So imagine we've got I funds, we've got J companies that these funds can invest in. So we define each fund's dollar holdings as in the second bullet and their assets. We account for capital gains return. You can see moving down the slide. Fund fees and distributions of dividends and capital gains and the bullets moving down the slide. We put this together, and the second big equation here, the big equation in the second bullet shows you how we put this together. This shows us how an institution's change in AUM is going to be the sum of its capital gains. That's that first, sorry, these slides are a little hard. That's that first term there. And then we had that added to that, the reinvestment of distributions net of fees. And then at the end, we add in dollar flows. And each of these things is going to matter for growth in ownership, growth over time. So the third bullet, by the way, is the more succinct way of understanding that big gnarly equation in the second bullet. And so that's the one that's going to flow through into the future slides. Okay, so this is our framework for fund flows, right? This is how we understand fund flows happen over time. Now let's see how this matters for ownership. So the first thing we do here is we scale flows by the fund's AUM. This allows us to really paint a more accurate picture of the effect on growth of a dollar flow, because a dollar coming into a tiny institution is going to matter way more for ownership than it does for a larger institution. And we do the same thing for the market portfolio in the last bullet on this slide. We essentially measure the change in our aggregate market flows over time, and we scale this by market value. Okay, so then putting this all together, we can approximate how each of these factors affect fund ownership over time. So in this equation here, in the middle of the slide, you can see the first term gives the fund's excess return versus the market, pointing right there in the middle. The second term shows how fund fees and distributions affect ownership, and the third term discusses balance sheet effects, whether the fund is growing faster or slower than the market as a whole. Okay, so that's the math. And now onto the data. And I'm going to spend less than a minute on this slide, which is so sad because this was like a multi-year effort that involved so much blood, sweat, and tears. I cannot even tell you. So we basically scraped 13F ownership filings for companies over a period of 20 plus years. And we merged this with CRISP data, and we took a bunch of steps essentially to make sure that we were isolating only ownership of domestic equity. And then we were able to measure dividend and capital gain reinvestment from Form and SAR filings. And all in all, we put this all together. Oh, and we also found data on expense ratios, dividend distributions, capital gains distributions. All of this came from CRISP as well. And so we collected it all, we put it together, and we assembled a very detailed picture of asset manager ownership and flows over our sample period. So what did we find? State Street. So this is a very different picture than the one you all have been told. Remember, the big three are growing exponentially. They're going to take over everything anytime soon. Well, when we look at State Street, we should not be so impressed. So State Street, we've got the blue line is its ownership, its growth and ownership over time, and its scaled flows are in red. So as you can see here, its aggregate ownership has basically been flat for a decade. And its flows have actually been negative in about half the sample period and close to zero over the past decade. Okay, so BlackRock is different. We see ownership, again, that blue line is trending up, but scaled flows are really close to zero in recent years and actually negative in several. And note that even though we see scaled flows have really flattened, right, in the past 10 years, ownership actually trends up by about 1%, which again suggests that some of the factors we've identified, fees, distributions, repurchases, these have all played a role in ownership growth. And another important thing to draw from here, if you look at those big gray bars, those show acquisitions. So look at BlackRock pre-2009. Its equity ownership was just about 1% of the market. And then with the acquisition of BGI in 2009, it launches up to 5.5%. So that is a huge factor that has led to its growth over time. Okay, Vanguard. Now this picture actually looks kind of more similar to what we would expect. Vanguard appears to be growing pretty steadily over time. It's more than doubled its aggregate ownership since 2010. But there's even some signs here of a slowing down. So we saw this interesting little dip in 2020 that persisted until 2022, and ownership goes up again. Scaled flows remain positive, but they are approaching zero. So maybe it's hard to make predictions, but maybe Vanguard's growth it will not be going too much higher in the future. And one more analytical point that I want to make before I get to our takeaways. So, the punchline thus far has been scaled flows don't tell you the whole story when it comes to growth and ownership. We've got these other firm and fund level factors that matter as well. And now I want to also emphasize one other thing, which is that market flows matter too. And by market flows, I mean basically whether or not there's a net market expansion or contraction in a given year. So market flows are going to be positive when the dollar value of buybacks, acquisitions, or going private transactions is lower than the value of equity offerings in a given year. And that matters for ownership a lot. So here's a figure from our paper. Again, it's that graph with Vanguard, and you see the ownership trending up and the evolution over time. Now we have these red bars, which basically show the difference between institutional flows and market flows. And this shows very clearly that once you subtract market flows from institutional flows, and if you get a positive number, ownership is going to increase, holding all else constant. But look at what happened in 2020. That when we subtracted market flows from institutional flows and got a negative number, we see the dip in ownership. So the bottom line here for ownership, for institutional ownership to grow, the flows that it receives have to exceed market flows. And so market flows have been mostly negative over the past decade due to net buyback activity. So, more money is flowing out than in. And this points to an unrecognized link between corporate balance sheet effects, like the decision to buy back stock, and the rise in ownership of institutional investors. And again, our framework suggests that aggregate buybacks can increase the ownership of investment managers that specialize in passive funds. Remember, they don't participate in buybacks. And so again, this really shows sort of an interesting insight that is that the decision of a corporation, okay, we're going to buy back stock instead of declaring a dividend. That might actually have consequences for the composition of your shareholder base. Okay. So let's get to the takeaways. The first one is about, a kind of a high-level point about the big three, market structure. And so a lot of studies that we've all, important studies that we've read talk about this sort of exponential growth of the big three over time. And a lot of these studies came to their conclusions by basically projecting historic growth rates, or actually even looking at the growth of non-big three institutions and projecting that forward. Other studies said, oh my gosh, look how much money is flowing into these institutions. The number just keeps going up and up year after year. And again, we show that those dollar flows don't tell the whole story. That doesn't necessarily mean that ownership is going to increase. And so rather than looking and projecting forward from what has happened in the past, we consider these underlying factors that matter for growth. And, we separated out acquisitions, of course, because it's hard to imagine that BlackRock is going to have another transformative transaction like the one it had in 2009. All in all, the evidence that we assemble suggests that this growth of the big three over time has been actually much less remarkable than many commentators have observed. And we've seen substantial differences between each institution. And there's actually also some data points that suggest a robust market. So in this table, we also looked at ownership, again, of U.S. domestic equity, U.S. equity of the 10 largest asset managers in terms of ownership. And so the 7 that follow the big three own about 12% of the market in aggregate. Capital Group is actually number 4, not Fidelity, which was a little surprising. And it hit a high point in 2008. Since then, it's sort of been on the decline. Fidelity has also been on the decline in terms of ownership. But look at Geode, look at JP Morgan, look at T. Rowe. They've seen an increase in ownership over the 2-decade sample period. So I'm going to skip over flows and just get to one more point on this market structure point. So we also look at the average number of institutional shareholders by firm, and we show that this has gone way up too. So, we had an average of 83 in the early part of the sample. It goes all the way up to 219 by the end. So all of this picture sort of suggests that, well, this is a pretty robust market. We can support smaller asset managers as well as giants, and the big three aren't the only game in town. Okay, so where to go with this? Well, I think the first main takeaway is that some of these radical proposals that we've seen that are responding to this threat of big three control of the market, these are probably premature. The big three are not growing as quickly as some have predicted. And so we probably shouldn't race to break them up or limit their holdings in industries and et cetera. Also, M&A is a really potent source of growth and ownership, and one that's expected to continue. There's a lot of M&A activity in the asset management industry. And so if we're worried about this rise of giant asset managers, maybe we should be paying more attention to asset manager mergers. And there's also this interesting interconnectedness between policies aimed at deterring buybacks, like these new recent proposed disclosure requirements for companies that do buybacks and a punitive tax. This is all connected to the growth of institutions in the big three. And this is worth exploring further. And we'd like to do more on this in the future. And more broadly, we hope that this is going to inspire, conversations about how exactly these giant asset managers are growing and better understand how they grow in ownership over time.
So thank you very much for having me. I'm feeling like I'm being put in a similar situation as Tobias. He before lunch, me before dinner. And I'm having to discuss a paper of two people I like so much. But before I say more, I'm here in my personal capacity or as an Oxford professor or whatever you want. I also work at PCOB these days, but this has nothing to do with that, and most certainly not with its board or board members or staff opinions, much less the chief economist's opinions. That's very different. Right, so look, I just think this is one of these papers of a collaboration between law and finance that this conference is made for now. So I like that very much. To give you an overview of what I'll try to do is, I'll tell you what I believed in before reading this paper, and then just walk you through how my prior is forced to move as a result of reading the paper. And there's some facts in the paper that seriously challenge my priors, and I think that's great, and that's basically a sufficient reason why people should publish it. The trigger warning is that I think some of my priors also challenge the paper's priors, but we'll see. Hopefully we'll all learn something from that. So the comments I have is mostly on clarifying precisely what the research question is. Then I'll show you some thoughts on measurement, but I'll leave most of that to the authors. And I'll end with a conversation starter of whether the policy suggestions, or they don't make policy proposals, they're being kind of careful in the wording, but whether those are directly supported or driven by the new facts that come from the paper. So here's my priors. Naturally, my priors come mostly from my own work. So sorry if this involves a bunch of self-references. But my first prior is that, of course, mergers and low fees drive the increase in corporate ownership concentration by the big three. So what this is a picture from a paper with two colleagues in Oxford. And what it shows you is the State Street line over time, and Vanguard's growth, and BGI and BlackRock over time. And you can see those are kind of like similar shapes as before. And when I looked at this, I was like, yeah, obviously, ownership concentration increases a lot if you let asset managers merge. And yes, the DOJ should be looking at that. And not just look at the market for asset management, but also corporate governance effects and competition effects. And yes, State Street doesn't seem to grow very fast. And aside from the mergers, BlackRock doesn't seem to grow very fast either. No, but Vanguard does. So my interpretation of that was, well, I guess Vanguard has the lowest fees because they're cooperative, and that's why they grow fastest, because people like to buy cheaper stuff. So at least I do, anyways. So that is prior number one. Prior number two is, okay, so this is getting, apologies to a few of you. What I'm plotting here is simulations of how a decline in index fund fees would affect households' portfolio decisions. Okay, so here's a bunch of households. They're sorted by how risk averse they are and how rich. So there's a few households that are very rich but have low risk aversion, And then there's households that are very risk averse and kind of poor. Okay, and on the left side, that is with relatively high index fund fees. Okay, and what you'll see is, well, the more risk averse people, they hold a lot of their portfolio, like 80% of it, in bonds. That's the blue thing. And they hold a little bit of index funds and a few individual stocks, which come with the benefit of not having to pay a fee. Okay, and the extremely rich households who are not very risk averse, they of course hold a higher fraction of their portfolio in equities, and they don't really care about diversification because, after all, they're not risk averse. So they save a bunch of money by not paying fund fees, you know, the Elon Musks of this world. All right, but as index fund fees drop, then of course more people, instead of holding individual equities, hold index funds. I mean, that's a story that you all presumably already believe in. But also a few people who never participated in the stock market, or not very much, they shift into index funds as well, because it's, after all, not that much more risky to hold an index fund than a savings account or a bond portfolio. Okay, so the point of that is, my prior was that declining passive fees shift savings from bonds into equity and from stocks into index funds. It's not just that there's flows from active funds to passive funds, as the paper says, that previous studies have focused, well, almost exclusively on the idea that investors withdraw funds from active funds and invest in passive funds. I mean, that's not wrong, they said almost, but anyways, so here's the third prior, which is a huge part of aggregate payouts that corporations make is financed with debt. Okay, so we know that. Well, if we know that, then we also know that gross flows to the equity market don't equal net inflows, right? What we don't know is how big that difference is and whether it matters quantitatively. No? And so, spoiler alert, this is where the paper then does move my prior. Like, that it happens, I knew. I just didn't know how important it was. No? All right, fourth prior is the following. We talked about the variation in institutional ownership. Let's now talk about variation in common ownership. So here's a table of 3 firms in the waste management industry in America, publicly traded waste management firms. Who knows? Who knew? Okay, so, and well, there's BlackRock, Vanguard, State Street, who filed 13 Fs. That's the data in the paper. Okay, and they're somewhere in the top 5 everywhere. But there's also that firm called Cascade Investments. Does anybody know what that is? That's Bill Gates' family office. Okay, so Bill Gates' family office holds a third of the one firm. Of course, they don't file a 13F. They file a 13D because they're not an institution. And they own 4% in the competitor as well. And hint, the Gates Foundation also has something to do with Bill Gates. So once you add these things up, there's a huge amount of common ownership, not driven by Vanguard and BlackRock between these firms, no? But if you ignore these red lines, these non-13F forms, you would also miss that the largest shareholder of that third competitor is some other family office that owns 45% of that company. So you would falsely conclude that there's a lot of common ownership between waste management and Rollins because Vanguard, BlackRock are the largest shareholders. That would be very wrong, no? But you would also falsely conclude that there's not all that much ownership or common ownership concentration between these two because you're missing Bill Gates' family office. My point is you kind of need to look at the non-13F filers as well to be able to make statements about this. Or more generally about the ownership concentration and how much institutional ownership there is. Right, in the paper, everything that's not a 13F investor is a retail investor. I don't know if I would call Bill Gates' family office a retail investor or these guys. Anyways, so, right, so by mergers we know that, that's a BlackRock BGI thing, but also by active portfolio decisions. There's this narrative out there, and I do not know where it comes from. Well, I kind of know where it comes from, but it does not come from me. That common ownership is driven by passive institutions and index fund growth. The variation in common ownership does not, at least not exclusively, come from those. Okay, and this is not an exemption like Pershing Square holds Domino's Pizza and Burger King and Chipotle's, like that's activists holding shares in the same industry as well. Anyways, so I think that's important to point out so we don't get distracted in an antitrust policy discussion by a bunch of index funds when, you know, there's lower hanging fruit. All right, here's the last of my priors. The last prior is, this is a Reuters article from 2016, which talks about Berkshire Hathaway is asking the Fed to be allowed to hold more than 10% in Wells Fargo. 10% is like a banking rule. You can't just hold more than 10% of a bank without being a bank holding company yourself, right? And according to papers obtained by Reuters, Berkshire said it learned in mid-March that its Wells Fargo stake increased over 10%. So, I mean, presumably they knew there was a buyback, and presumably they knew they held 9.9%, but they were surprised that that buyback let them. They didn't read your paper. So, anyway, so that happened to them. And 3 years later, it happened again. So this time in Bank of America, where, you know, surprise, surprise, the ownership rose above 10%. So oops, he did it again, I guess. So I would like to point out that because I'm a serious person, I did not make a generative AI video of Warren Buffett anyways. So what we knew and what we didn't know is, so I knew buybacks can increase ownership stakes, right, of particular shareholders in firms. But what I didn't know is how big of an effect that is, whether that can drive the aggregate flows. I knew there was an anecdote, but I didn't know whether that would explain why the percentage ownership of BlackRock grows over time, although there were no net flows. No? And that brings me to the point of how the paper challenges my priors or moves them or complements them. And it is, you know, these pictures that I think the key part of the claim is that quantitatively speaking, the increase of the big three ownership in firms is not due to gross inflows into the big three funds, but due to relative shifts, right, between funds. And buybacks that cause negative equity market flows, right? So the blue line you saw that was, you know, I knew that. The red line is the part I didn't know. No, that's the new stuff. That the red line is essentially zero. That's the flows, or in Vanguard it was a bit positive, but is now essentially zero. So that's the new part to me, just to clarify. All right, now I think that matters, and that's an important fact. For example, for macro finance models, we try to figure out, you know, how asset prices are formed as a function of who invests in index funds and all these good things, or you know, structural models. I think for those, for example, that matters bigly, and that's great. So people should publish the paper eventually, anyways. So I promised that my first comment was going to be on the research question. So the research question is the point here to offer a decomposition of the growth of institutions? Is a point to explain why Vanguard or BlackRock managed 9 trillion, you know, why are the institutions so big? Or is the point to explain the growth of ownership, but at the issuer level, right? So why do certain institutions own such large stakes? And that, I guess, would be the thing that matters for governments, right? So why does this distinction matter? Well, Cascade Investments is a small firm, but it's a gigantic common owner, no? So if you care about the governance or antitrust implications, you care about ownership at the issuer level. You don't care at all about the size of the institution. No? And similarly, a growth of the institution doesn't really imply issuer level ownership growth, or it only does so when everybody holds a valuated portfolio. But you know, not everybody does own a valuated portfolio. So. And in the paper, these two things are hardwired together, right? So the assets under management, as you saw the equation, the assets under management have like a direct link to the percentage ownership of an institution, and that's just not how that works in the data. Right, or maybe the question is, why certain institutions have their assets grow faster than others, right? So that's a cross-sectional point about why does Vanguard grow faster than BlackRock? And that would presumably have something to do with fees or the mergers and so forth. But it's also a different point of the aggregate flows mean that you can grow ownership without there being net flows to your fund. So anyways, that's just various versions of the research question that I think like are floating around in the paper. And I think the paper is about the growth of ownership at the issuer level, but that's for the authors to decide. Anyways, so the second comment is, I have a whole bunch of questions on measurement, right? So this red line, which is a new result, that relies on a bunch of assumptions on these decompositions. And I just have like too many questions to ask here, but I put them in the slides and we'll talk about them later. So one example of that is the point that passive funds don't participate in repurchases. And frankly, I don't really know whether that's factually how that works in real life. But I just drew two balance sheets. So here's one issuer, here's another issuer, and the issuers have machines and they have cash. And it's an all equity firm. Half the firm is owned by an active fund, the other half by a passive fund. Same thing over there. The issuers are kind of identical. right? So the total market cap of that firm is 2, the total market cap of that firm is 2, the passive fund owns half of it. That's what it means to hold a valuated portfolio, great. Now, if that first issuer uses this cash to buy back shares, and just from the active fund, but not from the passive fund, right? So how does the balance sheet look like? It looks like this, the cash is gone, the active fund is bought out, there's only the passive fund left, right? But now the market cap of that firm is 1, nothing changed in that firm, and the passive fund owns 100% of that. But that means now the passive fund is no longer evaluating, no? So he's no longer a passive fund. So that just to say, that makes me wonder whether that can really be right, that passive funds don't sell into repurchases or rebalance after repurchases. And therefore, whether at the issuer level, that can be an explanation, no? It's still true that, of course, overall, if there's a bunch of repurchases in the equity market, with finance with debt, say, that this shifts more money into the equity market and less into the debt market or the other way around, right? That's still true, but that's not going to explain issuer level ownership results. Hence the need to clarify the research question. Here's another example, right? So here's a quote from the paper that says, the sum of all the fund's assets under management must equal the market value. Okay, that sounds innocuous, but it seems to imply that given that we only measure the institution's ownership, that institutional ownership is always 100% of the market. But if that is so, then how can institutional ownership grow? So anyways, this is just me like having lots of questions, which can probably be answered. So the rest is just in the appendix, and we can talk about this. Hopefully I can be helpful in helping answer a few. So I already alluded to that just using 13F data seems kind of problematic. I mean, there's not just, waste management. There's also, I don't really want to understand Tesla's ownership without understanding Elon Musk's holdings, no? But Elon Musk doesn't file a 13F. He files a Form 4, or he forgets to file a Form 4, and then he has to file a Form 5. And anyways, right? And the good news is there's this website called corporateownershipdata.com that not only has the 13F data scraped from the SEC, but also Form 3, 4, 5, and all kinds of other forms. Because that's what I spent the last 10 years of my life doing. Because we had the same ambition. So since 2 years ago, there's a website that now a few hundred papers are using, one of which in the audience, at least. Anyway, so people can just do that. So I didn't quite understand why they went through the pain of doing this again. I'm very sorry for whoever had to do that. So that's just an invitation to everyone, right? And if you find mistakes or something, then you can help improve this. We just thought we should crowdsource this stuff because, right, there is no data set out there on WRDS or something where you get forms 3, 4, 5, and 13Ds and Gs and 13 4s and 13Fs. All merged together. That's why everybody else, that's why a lot of the papers in the common ownership literature only use 13Fs. That makes them wrong, but you can download them from WRDS. So anyways, that needs to end. So that's an invitation to everyone. The last comment is whether the policy suggestions follow from the analysis. So I'll also just give a few examples here. One example is, so let me just reiterate. The facts as they are, they already move my prior, and that's great. And nothing of what I'll say now takes away from that, right? So that clearly matters. That's sufficient. Somebody should publish it. But right, so there's all these words of that there's radical proposals to address anti-competitive effects and premature concerns and drastic changes to IO. So yesterday at dinner, we talked about how the finance people have beef with how lawyers write their papers and vice versa. And I guess that's just one illustration of that for humorous effect. So look, I mean, is it radical to enforce against Bill Gates' family office, like monopolizing an industry? I don't know. That would be a common ownership kind of antitrust action. Anyways, let's talk about a few. So one thing that's true in the paper is that the big three cumulatively own less than 20% of the market. Okay, that's fine. That's true. So that's on average across firms. Okay, and that's driven by the smaller firms, because in the S&P 500, the average ownership of the big three at this point approaches 25%. Like Vanguard on average in the S&P 500 holds about 10% of all the firms already. But the question here is, why does average ownership matter for governance? No, isn't it that what matters is the ownership of particular firms or particular industries? I mean, so in fairness to the authors, there's a lot of law papers that make all kinds of policy proposals that are super widespread across the entire economy and shouldn't we break up Vanguard and all that stuff. But I mean, the traditional way of doing antitrust is to go market by market and see if there's one market in which there's a problem. And what matters for that market is not what the average ownership is across the universe, but what the ownership in that market is, no? So that's, again, goes back to the research question. So to illustrate this is too small to read, but this is the two biggest publicly traded prison companies in America, CoreCivic and GEO. And in CoreCivic, BlackRock owns 16%, Vanguard 11%, and State Street 3.8%. If you do the math, that adds up to 32% or so. So these Hearst-Babchuk predictions, I mean, they've already happened. And in Geo, BlackRock 14%, Vanguard 10%, and so forth, right? And this is not an exception. In that paper I showed previously, we also plot what the mean and the median aggregate ownership of the big three is. And yes, it creeps up, and it's about 22% by 2020. But the max is way over 30%. So if you're worried about the big three dominating corporate elections, I mean, look at those parts where it matters. Don't take averages across a bunch of industries, I guess. Whoops, no, 0. All right. All right. The one thing that clearly would matter, right, is if there's reason to doubt that Vanguard will continue to grow. But it seemed to me like Vanguard did grow, despite the net flows not being the reasons, no? So I don't know whether it follows that therefore we should expect the growth to not continue. So I just missed a logical step there. That's the last one. I basically already said that, right? Vanguard's ownership continues to trend upward, but the scaled flows have declined. That's fine, but why does that make the antitrust implications less urgent? Like, why does it make it less urgent to enforce when an activist investor buys shares in competitors and makes them compete less? And right, so just to remind you, the effect of Vanguard's ownership on governance doesn't depend on why they grew. It depends on how big they are. It doesn't depend on whether they have an intention of changing governance. It's not about collusion. Mireia, who's somewhere here, and Florian Ederer and Miguel Anton and I wrote a paper just to spell this out one more time. The competition concerns that come from common ownership don't come from collusion. They come from like bad governance. Anyway, so what matters is not so much the cause of the growth of ownership, but the level of ownership that results from whichever reason. No? So all of this ties back to what's a research question, right? When the research question is what's driving the growth of ownership, then it has nothing to do with governance. That's fine, and it's a nice finance paper. If the research question is will Vanguard's ownership continue to grow, then it's a different question. No? So I would just make it way more focused, but that's just a finance taste. All right, so what do? Summary. I have to point out, the paper is exceptionally clearly written. I get upset at every paper that starts by calling BlackRock an index fund, which they're not, and the authors are way more careful in their language than a lot of the literature. And there's a clear contribution, I said that, and the conversation started here. It's really just whether these policy conclusions follow from the data we saw. Thank you very much for having me.
Thank you so much, Martin. This is really helpful and interesting, and this is going to make the paper much stronger once we work through all of the things you've raised. Couple things. I don't want to take too much time responding because you raised a lot of good things. Let me just hit on a few things before I open it up to the rest of the room. So, one point that you made that I think is a good one, that on the point about how fees will also drive flows. It's definitely also a piece of the puzzle here. In the example I gave you, fees matter because a higher fee means there's less money able to be invested in the market. But it also means that if you're a lower fee fund, you're likely to attract flows. My co-author really doesn't like that point because there's this paper by Burke and Green that talks about how that effect should just disappear in equilibrium, which is why I didn't raise it with you all. But I think as Martin showed, that there's definitely evidence to suggest that flows chase fees. and I've learned so much from Martin on the common ownership stuff. He was the first one to tell me, you're misunderstanding the common ownership literature. It is not driven by the growth of the big three. It's really driven by these other asset managers, not asset managers, institutional investors. So 13D filers that he showed you up there. And again, we kind of define the scope of our paper to exclude 13D filers. I can raise it with my co-authors about whether we should expand. Then they will be sad about that conversation. But we defined it more narrowly because we were really interested in institutional investment managers, because this is just sort of how the conversation has gone. The big three, Fidelity, et cetera. But then, Martin, I was interested to see you sort of suggested that, well, actually, BlackRock, Vanguard, and State Street, if we look industry by industry, they actually can be responsible for a common ownership concern, which is sort of how I read sort of the early period in the common ownership literature, and maybe some papers that were written by people other than you, who really say, if BlackRock owns every company, there's a real common ownership problem. And by the way, I don't put in the bucket of radical proposals the idea that, the DOJ should look at industries like the one you put up there, that, where you have BlackRock and Vanguard holding, large stakes in a very, very concentrated industry. I think that antitrust attention is warranted and makes sense. I think, again, and maybe this is a bit of a red herring, the paper is sort of responding to some of these more radical proposals that, I'm thinking about, like Eric Posner and Fiona Scott Morton and some others who wrote, we need to break these guys up. They can only invest, we should limit their investments to 1% of every firm in a concentrated industry. And I think, again, I don't think the picture that we show really suggests that happens, although we are not averse to antitrust and enforcement and inquiries by the DOJ, in particular on the merger thing. The merger thing to us felt like it was a really good avenue. If you're really worried about these guys growing bigger and bigger over time, M&A policy should matter. Okay, on the passive funds participating in buybacks, I really believe in this one. And I think that we did so many interviews with folks who were, high level executives at each of these institutions. And we were like, we just really want to understand, how does a passive fund handle a buyback? And they all said the same thing. And this is what they told us. When a buyback happens, passive funds can't do anything at all, because any trading that they do has not yet been reflected in the index that they're attempting to track. The rebalancing happens quarterly or once a year, or however often these indices rebalance. So they basically have to wait, and they can't do anything until the index rebalancing happens, and that happens by the underlying index. MSCI goes and figures it out a month or 2 or 3 months later or whatever. And so they are just sitting there when the buyback is announced, and everybody else can decide whether or not they want to participate. And so I agree, when you have, the simple example, the one fund, or, the two fund in the market example, it's hard to see that, but this does really track practice on the ground. And let's see. Oh yeah, I want to clarify one thing here. So I want to be really clear about what we're showing. So flows for State Street are flat, but if you look at Vanguard, they're positive still. So Vanguard still has positive flows. And so, I want to be clear that this isn't a picture of all growth of the big three has stopped, and we can't expect any future growth, because that's kind of the picture for State Street. But it's not for BlackRock, and there are still positive flows, slightly positive, not enormous, and the ownership line is trending upwards. So it could be the case. I don't want to say that, in 5 years, I don't want you to all say, oh, Dorothy said this was all going to stop. They were all going to stay right where they were, and we don't need to be concerned. I just think this picture of overall exponential growth happening, there's signs to show some slowing, especially with State Street, maybe with Vanguard. We seem to maybe be hitting an equilibrium point. This makes some sense too, as these asset managers get bigger and bigger and their ownership really just approximates the market. It's hard to see how they're going to beat the market and grow larger over time. And so I think, could you read this as saying we may be getting close to an equilibrium point? Maybe, but I don't want to make too much of that. I think the bigger point here that I hope you all take away is that when we think about future growth, all of these things should go into the picture. So yeah, okay, got some hands. Good to see.
Scott?
I think I want to amplify just a couple of Martin's points, most of which I agree with and I think are spot on. One is about the claims that you're making and the metrics that you're using, and I'm not sure if I'm being immodest in saying that I think you're taking aim at Lucian in my paper, among others. You were very polite about it in the paper. But if that's the case, I agree with Martin that really the scaled changes don't really speak to our claim. We're talking about the ownership claim, and so thinking about the scale doesn't actually help you, right? Like even if scaled ownership is 0, then I think it would still be consistent with what Lucian and I are saying, which is continuing linear growth, not exponential growth. The second point that I also agree with Martin on is the rebalancing. And I would just like you to talk a little bit more about it above the line in the paper. I think you have like one footnote 11, where you talk about it. To me, my understanding is that if they're rebalancing, that this takes away the kind of the buyback and the distribution effect after the rebalancing happens. So at most, this effect endures for like 3 months or a year until the next rebalancing. And I might be understanding it wrong, but maybe it would be. I think if that's the case, it might undermine some of the claims that you're making about the effect that it might have.
Dorothy, do you want to answer that or get a couple more questions?
What do you, moderator? I'll give you the.
We have about 7.
We have 7.
Why don't we?
Why don't I quickly respond?
Sure,
Oh no,
go
we
ahead.
only have 5 minutes. Holy moly.
Maybe Elaine will
then
give us
maybe
an
let's-
extra couple.
Let's collect it. I want to give special attention to Scott's question because he is the author of this very influential study.
Why don't you go ahead?
Yeah. So Scott, I just want to give Scott credit here because he's right. We all know that Scott and Lucian wrote these great papers where they were the first to kind of point out that there's this phenomenon of the big 3 growing and growing exponentially. And this was huge for us. I mean, this was our starting point in sort of unpacking what they did and understanding it. And so I really want to give kudos to them for the work that they did and for all of us for better understanding this problem. And also thank you for the close read. I like how you noted the footnote 11. That showed that you really read it closely. Yeah. So I don't think there's a ton of conflict between our 2 papers. I think our sort of takeaways and the tone and the mood music of the 2 papers are maybe a little different. And I think, I think what we really sought to do is maybe sort of improve the method of measuring growth over time. For example, I think that you are the study that didn't just project from historic growth, but you actually projected from non-big 3 growth and looked at that over time. And so again, we don't get to totally different places, but we just think about growth a little bit differently, and we separate out, acquisitions, for example, and we say it's hard to imagine again that growth is going to happen exponentially for BlackRock in the way that it has in the past. It just sort of paints a different picture. So with that, we've got 5 minutes. We all want to get out of here and have some drinks and dinner. So I'll take the questions and try to be quick at the end.
Okay, why don't I do 3, and then
Okay.
you can choose whether you want to answer
Perfect.
any or none of them. Yaron is next.
Well, a lot of it has been said, so I'm just going to keep it short. It would be interesting, and I know maybe it's a different paper, but there's a mirror picture, right? If it's not the big 3, it's some other common owners. And it would be interesting to see if there is a corresponding increase in, the next big 3, or is it just kind of like a dilution of holdings and moving to retail? So that's an interesting point to look at.
Okay, I'll go on to the next. Yuva?
Yeah, it was interesting to see the underlying mechanics of the growth of the big 3. At the same time, we can see that the number 4 to 7 does not seem to grow. So can you inform us a little bit about the underlying true economic forces which drive these differential growth processes? Just to also learn about future projections about that.
Okay, Merritt?
Yeah, I know there's disagreement in the literature about the importance of the current levels. I guess I would just urge you to stick to your guns in the sense that there are people who think the current levels are not such a problem, but a higher level could be a problem, and therefore your cautionary tale at least is worth keeping in mind.
Great. Okay,
Dorothy,
so
do you want to answer those three, or
I guess we only have a few. Let me just take them all, and then I'll do some wrap up remarks. I can't keep you late at the last session of the day.
okay? Jeff, are you going to keep us late?
Right. Market efficiency. So doesn't that suggest that there's kind of diminishing returns here? I mean, in other words, the Grossman-Stiglitz point, right? That essentially as passives increase in ownership, they're going to be positive returns to active investing. So that may place a limit on question to what extent could you say that places a limit on the growth of these funds?
Emiliano? John Morley. Where's John? Somewhere. You're making Jeff look bad here. Somebody say something.
The
I've
last
shamed
word is
everyone.
always good.
All right, Dorothy.
All right, I've shamed everyone into giving up, but hopefully we can talk later. With just a minute to go, I think I'll say, there's a lot here that I think is really interesting that we didn't get into, that, questions that I continue to have. Why do certain of these smaller institutions manage to grow over time, and while others are declining? And, what's going on with Vanguard, for example? Vanguard is the only really truly exceptional case here where I think it really fits this idea of, wow, it's, rocketing forward without a lot of stopping. And I think we have some idea, and I should also say the impact and the amount of each of these factors that we identify. Again, you can see this best with BlackRock. BlackRock's flows are pretty flat, and yet we see ownership trending up by about a percentage point. So what's going on there? These are things that we wanted to unpack and we hope to do in future work. So hopefully stay tuned, everyone, for the chapter 2 of this, which will hopefully answer more of your questions. So thank you so much.